The Japanese stock market, the Nikkei, has hit 30,000 for the first time in 30 years. Oil is back above $60 a barrel. What does it all mean? That's going to be the topic of today's video. Now, what's interesting is I've been talking about the Japanese market now for a few months, and I mentioned before that I thought that if the Japanese market hits 30,000, there's a reasonable chance the sentiment could change towards the market and it could go towards 38,000, its previous height. I'm not saying it's guaranteed, of course, but I just feel like sentiment is changing towards the Japanese market, because I think previously, no matter how cheap the Japanese stock market looked, people always thought, oh, but it's Japan, right? It's the only stock market in the world, the only major stock market, which has been down in capital value terms for over 30 years. But now what's very interesting is you've got two or three things. First of all, you've got the Japanese market trading at 30,000, 30,400 and something when I'm making this video, which is the highest level for 30 years. Secondly, as I mentioned before, anyone who reinvested dividends would have actually been up by now in terms of the Japanese stock market. Three, of course, it's very unrealistic that somebody would have literally bought one time during the height and then not invested until now. So actually, all these things do show that actually, even when it comes to a very badly performing stock market, because let's face it, even if the Japanese stock market goes back to its record, compared to the S&P 500 or Nasdaq, Dow Jones, MSCI World, it hasn't performed well, but it does show that even a very bad performing stock market, if you're willing to be patient, reinvest dividends and hold that stock market in conjunction with other investments, you would have done very well. Let's say 35 years ago or 33 years ago, when the Japanese stock market was at its height, I forgot the exact date, I think it was about 33 years ago, you would have bought the Japanese stock market, the S&P 500 and a bond market index, and all you did was hold it for 33 years, reinvested the dividends, you would have done pretty well. So it shows the importance of diversification, reinvesting dividend income and being long-term, whereas somebody who would have panicked in the middle and thought, wow, this has been down for 10 or 20 years, wouldn't have made so much money. But what's interesting is, in addition to the Japanese stock market doing very well, many Asian and non-US stock markets are actually outperforming the US stock market now, and oil is back to $60 or above $60 a barrel. And I think what's interesting now is this: you've got many trends colliding here. Number one, you've got people feeling optimistic about the vaccine and, back to a new normal, so to speak, so that's also helping oil. But I think you're seeing a situation where people know they can't keep their money in the bank. Institutions know the same thing. They're still optimistic about the US stock market, especially the tech-heavy Nasdaq. However, the US market has been outperforming for over a decade now, and these things go in cycles. So in 2000 until 2010, the US stock market did worse than some international markets. So I think what you could see going forward in the next few years is some of the unfashionable or previously unfashionable markets, the UK, the Japan, the Korea, those kind of markets could do very well. And what's interesting is last year, the South Korean stock market did the best out of all stock markets in the world. Only the Nasdaq did better, although the US stock markets in general didn't do as well. Korea was followed by Taiwan and mainland China in doing very, very well as well. It's had a great start to this year as well, the Korean stock market. So you're seeing people look for value. In other words, stock markets that aren't highly valued on a price to earnings basis. So I suspect there is a chance, and nobody can predict these things, that by the end of the year, the US stock market will have another pretty good year, but some of the non-US stock markets could actually outperform this year, I think. But again, stay diversified, and also remember something else, that whenever there's a risk on, people go towards the US dollar, they go towards US treasuries, they go towards those tried and tested markets. So if we ever have a very big crisis again, it's actually likely that the US markets will outperform, relatively speaking. I mean, if you go back to the worst of the crisis, all markets last year were down very sharply during the very worst of the crisis, but the US stock market recovered most quickly. And I think the US is seen as a safe haven, whereas the likes of Japan, UK, even though they are developed markets, they're seen less in those terms. And likewise, emerging markets even less so. So if you look at the global financial crisis of 2008, 2009, emerging markets got hammered But then in 2010, they had a great upswing because people were thinking, oh, things will get better now. So I think what we could say is if the economy gets back to normal or near normal, those emerging markets, maybe UK and mainland Europe and Japan and those developed markets that aren't the US, might actually outperform. But if we see some disappointing economic news, we might see the dollar increase. We might see more assets go towards the US. So I wouldn't get too excited about it. I'm not saying sell all your S&P 500, sell all of your Dow Jones and go towards the Japanese and British and Korean stock markets. The US long term, I still think, has a great chance of outperforming when it comes to the stock market. But I do think the next few years, there is a chance that people will look for dividend and yield and indeed more underperforming assets. And the UK and Japanese stock markets are just two examples of trends you could see. I also think the UK could do quite well now that the whole Brexit situation has been resolved, and indeed some of the undervalued mainland European stocks as well.